we're going to talk about opportunities in private equity. So everything you hear about is there's two things you hear about today. It's private equity or SPACs, I guess they're kind of interrelated somewhat. SPACs are an exit for private equity. It's been very intriguing. I get phone calls all the time about different private equity deals, as many people in the room do as well. And one of the things I have to say about private equity is that there's a huge expansion in private equity and the venture capital side. When it comes to growth private equity, I have seen so much of it, and it's happening everywhere. So multiple things are happening. One is that there's a huge gap in funding for post-Series A businesses, right? So if you go to Silicon Valley, you're going to see there's probably 1,000 micro VCs in Silicon Valley, and they're putting up a couple 100,000 here, a couple 100,000 there. The companies are getting past their Series A, and then there's like a desert for Series B, C, D, et cetera. Capital is being raised. People are looking towards alternative methods to get financing, and so a lot of people are stepping into this growth vacuum that exists, and you're seeing that on private equity growth. Secondly, what I'm also seeing is more alternatives for going public. So I got a statistic yesterday from somebody. There's more than 400 unicorns in the world right now. So 400, startup, tech, venture capital, private companies globally that are unicorns, with about 20 to 30 going public any year. So on IPO. So there's like a long line to go public for the next 10 years, and because there'll be more unicorns as well. And that in America, the typical company that's going public has more than a $10 billion valuation of these venture. So you're seeing a lot more companies going public in other countries. And so I was told that in Australia has become a hotbed for fintech companies going public at $50 and $100 million valuations. Canada, which we know from Austin, Texas, because Canadian, not the embassy, but the Canadian group out there in Austin has come to Austin and pitched us many times. So they will move people out of Austin next day. They'll give them optionality to work the next day with office space for a year for free. So there's a lot of countries that have become very aggressive on the tech front. So got a great group of speakers here. Elliot Holland, who is a expert on private equity from Guardian Due Diligence, will be leading the panel. And then we've got a great group of speakers. I hope I can get an extra chair here for Michael. There's one over there. Perfect, great, fantastic. Great. Elliot?
All right, good morning, everyone. I'm excited to have this panel today, and we have some great folks that have some great expertise around the topic. I imagine we will get into some questions that we've already sort of sourced, and then move into ones that the audience may have. Pretty hot topics, so I think we'll be fine. What I want to do first is go around the room and have the folks that will be on the panel introduce themselves. I'll start right here with Will.
Hello, Gupta, founding managing partner for Low Key Group and Low Key Equity Ventures. About myself, over 20 years of business professional experience. I've led over $100 billion of deal transaction value, and 4 years ago have started focusing on my own venture capital and PE firm. With that, have done 9 VC investments, have had 2 exits, and working on the others for the last 2 years, have been focusing on private equity opportunity as an independent sponsor, and currently focusing on a single industry roll-up fund in the paving industry.
All right.
Good morning, everyone. John Austinson with Framebridge Capital. At Framebridge, we really stand at the intersection of investors looking to deploy capital and opportunities within franchising, oftentimes in non-food franchising. That's where the majority of deals are. We offer several ways to participate, either on the direct end, where we work with about 400 different brands, or more indirectly in a fast-growing area for us. It's more of the passive opportunity for investors, which I can get into a little more detail on. My background: served as president of Shell Genie franchise system. It was an Inc. 500 franchise system. Actually, just sold to Neighborly, formerly the Dwyer Group, this past week. So that's hot off the press. I'm a multi-brand franchisee, franchise consultant, and franchise investor myself. So all things franchising is, that's the world that I live in.
Thank you for that. Michael, can you introduce yourself?
Thank you. Michael Hollingsworth. I'm a corporate lawyer here at Nelson Mullins and help a lot of private equity and family offices with their investment strategies. We also, in addition to helping people with equity investments, we also have a fund formation group, which I'm co-chair of. Kay Gordon in New York is my co-chair, and we work closely together on all types of funds. And we also do private label funds for RIAs and family offices. I'm also a fund of funds investor as well as a direct investor. Unfortunately, COVID has hit my boutique fitness investment pretty hard, and that's one I wish I could forget. But at any rate, I invest all the way from venture funds to real estate funds, just a typical allocation.
Excellent. I'm sure you're not the only one that is looking at some investments in the portfolio right about now, Michael. I think you have a good company here at the table. Myself, Elliot Holland, founder and managing director of Guardian Due Diligence. I've spent the past 10 years as a principal and now as an advisor working on and helping family offices, independent sponsors, and acquisition entrepreneurs, / anybody independently doing deals to execute transactions, focusing on due diligence. So we work with folks, we provide a full suite of buy-side services from sourcing to evaluating to commercial due diligence to capital raising. But we're oftentimes brought in to do commercial due diligence, which helps a lot of family offices particularly set up their direct investing offices. So we've been doing a lot of work in that area. I think I'll open up. One of the questions that I think is on top of mind sort of industry-wide, but also here in the room, is sort of the intersection of private equity and family offices and how are folks actually going to market and what are you seeing trend-wise? And so I think I'll start, hello, do you want to take off on that question?
Yeah, sure. Thank you, Elliot, for that. So what I've been seeing is between family offices and PE, and there's a large variety of different working relationships, but what I've been seeing is a lot more interaction, and then also a lot of family offices looking to work with more independent sponsors like myself and even PE firms, right? One thing that we can never get more of is time. Time is the one resource that's limited, and but one thing that's not limited is the number of deal flow that probably gets passed around, right? And so with the number of deal flow that's out there, leveraging and using independent sponsors or other folks who already have access to deals is a great way of being able to shift through a lot of the deals that may not make sense for family offices and be able to look at the gem of the gems and be able to pick from that. So by having a more select group of companies to look at and having other folks who are able to do all the grunt work, like I'll say, of reviewing deals and figuring out what makes sense and what doesn't make sense, they're able to more wisely invest and leverage their family office funds and growth.
That's a great perspective on the sort of buyer side. Michael, I'd love to get your perspective on the transaction sort of legal side. What are you seeing trend-wise in terms of family offices and private equity deals currently?
Yeah, if you think about it, a lot of family offices simply don't have the infrastructure to lead on the diligence side. And so what I've seen is a trend away from just handing your money over to an upper tier private equity group where a lot of family office managers feel that there's a severe lack of transparency on fees. And also they look for either an independent sponsor, fundless sponsor, or like we have a client in Nashville called Claritas Capital, and they're a committed fund. And they primarily invest in healthcare technology, but they have a robust co-investment program. So on any given deal, they might fund half of the equity out of their fund and offer their investor base. Many of the investors are family office investors, the other half of the equity. And so that group is small enough for the family office to feel like they have some influence over the manager. Whereas if you're going into Carlyle Group, I mean, they have great returns, but I don't think you're going to pick up the phone and call Carlyle and tell them your opinion. Or you might tell them your opinion, but it won't have any influence. So that's what I'm seeing. I think that from a legal documentation perspective, I've seen over the last few years, I've seen a lot more detail on the expenses provisions in documents, so that especially institutional investors counsel really want to lay out exactly what's being charged to the fund and what's the general partner is covering, which usually is not very much. But at least there's an attempt to be more transparent. And quite frankly, the SEC has been all over fund managers about fee transparency.
Yeah, I mean, I think that makes sense. I think the overall trends are definitely for people to evaluate different sort of deal strategies, moving away from some of the more traditional fund investments to fund of funds, club deals, independent sponsors, and the like. I think let's keep going on that. In terms of sort of structure or sort of specific insight that you see sort of independent sponsors and family offices being able to collaborate together around, do you want to hop into that at all in terms of how you see sort of specific opportunities or sort of businesses where that intersection has been really favorable for you?
Yeah, so I think like right now, a big piece, especially in the pandemic, a great way of creating value is roll-ups. We've all heard about roll-ups, PE firms doing roll-ups. One thing though that makes it a little more specific in family offices working with independent sponsors is that the ability to be more focused and then their ability to really manage their risk profile, right? If they're an investor in a PE fund, they're one of many, and that PE fund is going to invest in 10, 20, 50 companies, whatever that may be. And whatever their investment is within that fund, they're the same percentage across all those investments, unless there's a sidecar type structure like Michael was talking about that allows them to co-invest alongside that. With an independent sponsor, and kind of the way we're working with family offices is they are looking at it and they say, okay, you're going to do a roll-up in this industry, right? So we're going out, we're focusing right now on the paving industry. We see a great opportunity in updating about infrastructure, creating of new developments and parking lots, and really taking an industry that's very just segmented and bringing it together and creating the larger opportunities and economies of scale that allow for greater growth. And by having that focus, they know exactly what we're doing. It's being very transparent about what the opportunity is. And they actually then also get a seat at the table where if they want to be a board member to the fund and understand what we're doing, they're involved in the process. And they're really appreciating that opportunity of, okay, getting more involved, getting some additional insights, and having someone who's there to operate and manage the roll-up and acquisition and investment on their behalf.
That's a perfect segue. John, I want to bring into the conversation.
Yeah.
A lot of family offices, just in general, franchising is pretty particularly interesting part of the private equity market, particularly here in Atlanta. Can you talk to us a little bit about what is maybe a bit different in franchising and private equity, particularly as it pertains to what Luke just mentioned around the trust that people need and the work that has to be done around operating some of these assets?
Yeah, no, great question. And you mentioned the paving company. I actually purchased a driveway repair company 2 weeks ago. So, yeah, riches in the niches. But what we're seeing is private equity. Really, the bigger players have franchising on the radar. Oftentimes, it is QSR type businesses, but there's a whole world of franchises that operate outside of just food. And so, I think oftentimes people think Subway's, McDonald's, and it gets pigeonholed. What we're seeing is more and more investors and family offices recognizing, hey, stock markets up here, we're nervous, interest rates down here. There are a lot of good real estate deals to be had, but how do you diversify? And so oftentimes I feel I'm preaching the gospel out there talking about franchising as an asset class. That was actually the title I gave to a presentation last week to a group of investors. And, private equity loves franchising for multiple reasons. One, banks love it, so it's able to be levered up. Secondly, it's a very understandable business by and large, so it helps diversify a portfolio, by bringing innovation, by bringing, the potential to roll up, or at least to bring that brand and that consistency and quality into oftentimes fragmented markets. So, a big section that we're fans of and we invest heavily in is home services, property services. It's a $500 billion growing market. I can get into all the details of why it's thriving right now. Happy to do that. But that's a sector that is largely fragmented, mom and pops. And if you can come in, provide that branding and the back end structure, then you can really generate some attractive returns that I think more and more people are looking for these days.
Can we dig a little bit deeper on franchising as an asset class? I think it's a very interesting point of view and talk. I think more broadly just franchising, but I think as private equity matures, they're becoming niches within private equity. They're becoming almost their own asset class. You could consider independent sponsors their own asset class. You could think about franchise. SPACs could be a different way to think about this. Can you dig a little bit deeper around like the niche and sort of the asset class around franchise and private equity?
Yeah, in the past, typically we would see investors participate more at the franchisor level, but we're starting to see it more and more now at the franchisee level as well. And they'll come in. I had a deal I reviewed yesterday, it was for 9 locations. I can't say which one it is, but for 9 locations looking to do a roll up. And it's starting to see more and more of that in the boutique fitness space, but also in more of the services space, those essential services. I mean, pools are a great example. Everyone's getting a pool. I mean, the business is up 30, 40%. In franchising, actually, over the past 3 months, the deals that we've done, participated in, up 50% year over year. So I think COVID, really hit a lot of people. Obviously, people are concerned about job loss, so franchising becomes more common and on their radar. But also, we're seeing baby boomers starting to retire. They don't want to totally exit, the workforce. They're looking for those semi-absentee opportunities. And then we're also seeing a lot of people that sat back during COVID and said, I'm not sure about the path I'm on, with my corporate gig. I'm a little tired of this, don't want to go back to the office. How can I become a business owner? Many out there think it has to be that next big tech startup, but we're seeing a lot of gravitation towards proven business models and systems that, again, banks like, the SBA likes, and more so we're seeing investors participate in.
Excellent. I think a question that may be top of mind for a lot of folks is when we get into the private equity landscape and you're an independent sponsor working with a family office, your family office going direct, or you're working alongside a family office, maybe your dollars riding alongside theirs. How do we think about competing family offices going to do private equity relative to a private equity firm? Although, do you have any experience with that?
So family offices competing with private equity?
Well, family offices and sort of institutions connected to them doing deals, competing with the Carlyles, TPGs, the Rourkes of the world.
That's a great question. I think, with family offices, the Carlyles of the world are just really large organizations. They have large teams. They have with large teams, they have a slew of operating partners and individuals that are doing all the financial analysis and whatnot. And if you think about, family offices in general, right? Again, very different, a lot of different versions of family offices, but in general, family offices don't necessarily have the large staffing that some of the bigger PE firms have. So with that, you gotta look at deals differently. You look and you operate and you transact with the deals differently at that point. So for that reason, you need to staff yourself up, right? And so usually what you probably want to do is find a partner that will help you do that, and I'll let you then be a part of it while you figure things out. So I have a family office for the more of a family enterprise right now. They haven't created a family office per se, but they're in the construction industry. They have a number of different businesses along that line. They have real estate development, they have equipment rental and whatnot. And, they say we have these businesses and they've moved in a way where they now have non-family members operating them. And for the last 20 years, family members are running these businesses. And at a certain point, they're like, we don't know how to grow this any further.
Right.
We need outside help.
Support.
Exactly. And so that's where, I think it's key and smart for any individual, PE or a family office, that the limitation of what you can do, and you bring in partners to help you, which is why you call in folks like Nelson Mullins, where you need legal work, you need to drop the PPM or whatever it is. You call on John because you're looking at getting the right franchise. John will help you find the right match, right? Okay, let's QSR. Is it a wireless provider? What is it? So I think that's the key.
I was told to speak up, so I think I will. Michael, you have some points?
Yeah, I want to make a couple of points on your question. talking about the trend towards some family offices moving from a fund-to-fund strategy into more direct investing. First of all, I think that in your example about competing with Carlisle and Apollo and people like that, most family offices, if they get into an auction process, they're going to lose. So my point would be that family offices have to compete on something other than price, because they're typically not going to want to lever up the business to the level that a traditional PE firm is going to do. And typically they take a longer view of the investment. So they're not going into the investment trying to figure out how they're getting out in 5 years. Exactly. And so I think where family office investors can be competitive is offering that flexibility. They can offer different deal structures such as minority recapitalizations or other flexible alternatives to a pure buyout. A lot of times founders of companies, it's not all about price, and they really are looking to preserve the culture and also make sure that their employees are taken care of. And I think family office investors can have a much lighter touch than some of the institutional PE firms in that regard. So they have to be a little more creative, a little more flexible. But I think that if you're looking at an investment for the long haul, they can compete. It's just that, the upper middle market is so efficient these days. You never find a upper middle market company that's not running a process.
Right.
And so I think there are more opportunities in the mid middle market, lower middle market for family offices, especially if you could, for example, yesterday I had a deal die because the private equity firm in San Francisco said that they couldn't get comfortable with the customer concentration. Well, the customer is a huge European conglomerate that's been there forever.
Right.
It's 90% of their revenue, but it's like clipping coupons. I mean, right. It's that we won vendor of the year for like 10 years in a row.
Exactly.
So I think a family office investor is the right investor for this business, not traditional private equity. Because private equity has to go back and tell all of their, scattered about LPs why we just did a deal with 90% customer concentration. Whereas a family office, especially a single family office, you have a family and they say, oh, we don't mind,
Exactly.
And so you don't have that fiduciary risk that a traditional PE firm has with that set of facts.
I think
Michael, can we talk a little bit about, just one quick second, talk a little bit about family offices committed capital? Because, people come to us all the time looking for investment and they'll say, well, maybe I want to work with a venture capital fund or a PE fund, not knowing that from a venture capital point of view, funds are very specific on what stage they're going to invest in, whereas a family office can invest through multiple stages, right? And a lot of them actually only will invest on early stage when they want access to later stage. Likewise, family offices are far more likely to be thematic in terms of investing over the long term, as you mentioned, right? Which is that maybe they want to be in a specific area. And we're going to have somebody from SpaceX presenting on the venture capital panel. And a lot of people want to be in space. That's actually a whole asset class right now. And there's family offices, yeah, sure, we want to be in that, or longevity. And so maybe you can talk about that a little bit.
I think most family offices, many of them are very, very real estate heavy. And that's because, the family has told whoever's, the chief investment officer, our goal is not to get rich, it's to stay rich. And so it depends on, the risk tolerance of the family ultimately, or the multifamily office. But, a lot of family offices, on the front end, they will say, okay, we're going to have a 60% asset allocation to public equities. And so that 40% that we're going to do in alternatives is going to be split up between LBO, real estate, venture capital. And usually, in my experience, family offices are not huge on venture capital.
Correct.
It's too risky. It takes too long to get your money back. You're going to have 2 out of 10 deals that are really successful, and the rest are probably going to zero. And family office investors typically do not like going to zero.
Right.
And so it's really that mindset. It's more of a, hey, can we find a real estate investment or a private equity investor that's going to throw off current income and have some upside, when we trade out of it. And so, but on the venture capital side, here in Atlanta, for example, we have had success in the last few years with some incubator funds like Engage, which is loosely affiliated with Georgia Tech, but our client, Blake Patton of Tech Square Ventures, is actually the general partner. He runs that, and that is a incubator fund that basically is funded by large corporates in Atlanta, Cox, Invesco, Georgia Pacific, that type of company. And so that's creating a little more capital base on the early end so that they can get the companies to the next level. And a lot of family offices start to get comfortable at like the Noro Mosley level in the capital evolution, which is really post Series A,
Sure.
like growth equity.
Yep.
And so that's a less risky proposition for them.
Great. Now, we couldn't have a panel right now without talking about COVID. It wouldn't be fun at all. So have you guys seen successful sort of corrective action and or strategies with private equity and family offices during COVID, or maybe some that you found interesting? John, maybe we'll start with
Yeah, I may defer that one actually.
Well,
Michael.
Yeah, I hate to dominate the conversation, but I will say that COVID has, through no pre-planning of their own, there are some real winners and losers coming out of COVID. Obviously, if you're in hospitality, that's probably a tough spot right now. But a lot of our tech clients, especially ones that have technologies that enable collaboration, are doing really well.
Right.
But it's not just tech. For example, if you are a manufacturer and marketer of consumer products that are largely focused on the home,
Exactly.
you're doing really well because a lot of people are making more food at home. I have a grill manufacturer client that had surpassed 2019 revenues as of April.
Amazing.
Because they're direct-to-consumer marketing, primarily use Facebook for their marketing, and they have a cult following like Yeti, and it's just amazing. And I would say that the one thing about that I found during the COVID environment is that people that you've been trying to have a conversation with for a long time are way more open. They're grounded. They're not on planes, trains, and automobiles.
Right.
And, there are private equity groups I've been trying to get in front of in New York for ages that I finally had a Zoom with or whatever. And so I would be aggressive in trying to get in touch with people that you want to do business with, because it's like a unique opportunity to get in front of people. I think some people are just bored, and if you offer them a Zoom, they're like, or a phone call, they're just ready to talk about anything.
I've certainly had a higher conversion rate in the past 6 months than ever before.
Yeah,
for sure.
exactly. And so that's sort of my, most of our clients are actually doing quite well during COVID because we're heavy in healthcare, heavy in technology. Telehealth deals are going berserk. Digital health companies are growing rapidly, and so.
And then all the stuff that supports that, right? So you're talking about transportation, you're talking about waste, all the things that are sort of enabling people to be at home, take care of those pizza dinners, get them out of your house, provide entertainment, Netflix of the world. There's a lot of things that are going well. And even more so from my perspective as an advisor, people are always asking me, well, where can I look now?
Yeah.
Valuations are down. People are a bit nervous. The funds may have a more difficult time making investments right now, just kind of anchoring towards the mean. But if you're looking at a 10-year, 15-year, or infinite horizon, the relative sort of 3 to 4 year low of anything isn't as relevant. So I think there's a lot of opportunities for family offices to play a bigger role in this environment, both from a distress perspective and just as a continuation capital, right? Or any sort of capital perspective at a higher return.
Yep.
Hey, can you talk a little bit about private equity in general? And you kind of just hinted at it when you talked about risk and about distress. And also, I know that, you know, when it comes to on the sponsors, independent sponsors, they really approach their deals differently, and business owners look at them differently than they look at private equity funds.
Yes.
Right, they tend to develop longer term relationships.
Yeah.
The private equity funds like independent sponsors because they have that relationship in place and they trust their analytic ability and their knowledge of the company, et cetera, and the sector. Because I mean, what we've seen, I'll give you a great example, HIG Capital. It's a pretty well-known group. It's a bunch of Harvard guys down in Miami. I don't know, are they at 20 billion now under
It's
management?
huge, whatever.
Right, they used to, I knew them when they were like $3 billion under management, right? And they had a routine of sending out a postcard every month to 10,000 companies, right? In the US, they had a mailing list of 100,000 companies, right? So those companies have become vast.
Right.
And so I think there might be segments in private equity that aren't being paid attention to because the successful companies have grown dramatically. Just like you see in hedge funds, the smaller companies haven't necessarily picked up this.
A lot of them are just going and saying, hey, I'm gonna own transportation. I'm gonna own franchising. I'm gonna own technology-enabled industrial businesses. And so now that's gonna be my niche. I'm gonna call on those companies, I'm gonna call on those advisors, I'm gonna go to those conferences. And so now you're 10 years deep in a particular industry. And then people forget in private equity, there's always the price, but there's also the relationship with the seller. The seller can sell to anyone. And so when you get outside of sort of the context of sort of the cash check at close and realize that the seller is going to be an employee of the buyer post-close, and these people have ultimate freedom until they become employees, a lot of family offices, independent sponsors, I think, are winning on the margin. Being able to be a more real, a more partner, a real person as a buyer, and not just this institution that's always saying fiduciary LPs. You know, you talked about risk. Risk as a buyer is price-based, how much do I pay for the asset, right? Operations-based, who's gonna execute this plan? And then capital-based, how much of my money goes in, how much of somebody else's money goes in? And so people are sort of thinking about that all the time. And then what we talked about a lot here is sort of duration. If my money has to come out in 5 years, I'm way more nervous about cycles and timing than if it's 10 or question mark years. Also, if I'm selling, I like question mark because the employee retention, the keeping the name on the shingle, the being a part of the community as some of these deals get outside of big cities, that stuff matters to sellers, and essentially buyers are courting sellers.
Yeah, I was just going to mention what we see right now is a lot of investigation for subject matter expertise and really those niches that are understandable, that you know, and I'm a little biased here admittedly, but we're seeing a lot of interest. So we're doing a capital raise right now with my partners. We've got 3 home services brands in Atlanta: carpet cleaning, pool cleaning, and home cleaning. We're building out that portfolio to 12 to 15 brands over time. We're seeing investors really interested in what we're doing because it's very understandable. It's seen as an essential service, and we're giving them a passive opportunity to participate. But you were mentioning different industries that are winning out there. You know, the whole silver tsunami and what's going on with seniors, and some of them are nervous to be in nursing homes now, so they're wanting to age in place, which it was frankly a trend before COVID. But those that cater to that, not just in-home care, but they're the ones developing the chairlifts and the ramps and, you know, everything on the periphery there, or health and wellness. While some of the fitness sectors have been a little tougher, I mean, overall health and wellness has never been more interesting. And I think like the IV drip bars out there, and you know, there's some that have what's called a certificate of 797 certificate, allows them to administer a cocktail essentially that fights free radicals at the cellular level. I mean, those are the kind of things that are winning right now. So I think that's what I'm saying is more niches and more understandable investments.
Just to add on that, it's not really home. So I think Michael addressed home delivery companies like that are, you know, distributed into the home. You can work from home, but there's a whole bunch of other home services that you're catering to, that other people are catering to as well, which is that this whole home automation, home robotics. I mean, in Japan, there's like robots for everybody over 70 years old, right? And that's going to become a movement in the US as well. It's just going to be more cost effective, right? So you know, it seems like that's a really big trend, and maybe it goes back again to this whole thing of narrow casting, you know, on what segment you're looking at. But again, you know, I want to get back to the whole theme of independent sponsors, because my thought on independent sponsors is that when you look at a general private equity fund structure, the people who are junior are typically talking to clients, right, who don't necessarily initiate the initial contact, but the people who are, work with are pretty junior people. They don't have sizable industry experience. They develop it over time. But when you get an independent sponsor, a lot of time that guy is gaining substantial experience. He's done several deals, et cetera, he or she. And, there's a great chance that they'll be able to develop better relationships. So our independent sponsors kind of selling that relationship part of the business, as well as the fact that they're analytical, et cetera.
Sure. So definitely. I mean, when I've talked to sellers, they really love the fact that I come with 20 plus years of experience, and I've worked on deals and I've worked with executives and board members. And when I talk to them and how I talk to them and my vision for their company, they get on board. I'd say many of the times when I've gone further in the process, I rarely was ever the top bidder, because I'm looking at an opportunity. It's like there's more here than what you believe in. I'm not going to just pay you money just to go walk away. There's a bigger plan here that I want to put in place with you. And sellers usually latch onto that. They really like it. And I think for that reason, so do family offices. And there's different places in the industry that PE firms, family offices, and independent sponsors all play, right? PE firms are generally looking to cut much bigger checks, much bigger deals. They're looking to do, bare minimum, maybe a $50 million check and higher, and they're looking to do a $100 to $500 million deal, where a family office, depending on their size,
Right.
maybe looking to do something a little bit smaller, right? And with an independent sponsor, they can actually do that, and they can really become a partner together in that, and have someone they can trust work with them in managing their funds, right? And if you think about the roll-up opportunities, when you look at the small and lower middle market, there's a huge opportunity to create a lot of value by conducting a roll-up, by bringing the organizations together. Many things you can do is, if you want to centralize the back office, be able to expand your the services you're providing, and be able to then take that expanded portfolio of products or services to the current customers and current clients, and be able to create more revenue that way. Then when you grow it to a certain size, then you can always then exit it to another PE firm.
Exactly.
And
become a facilitator of that.
exactly. And that's where your independent sponsors can really help out, as well as family office members, is by not only helping and operating the company and understanding it to be able to provide that insight, but then having and owning the relationships with family offices and PE firms that can then be potential buyers in the future.
And also, there's not a lot of private equity firms that are looking at deals under $2 million in EBITDA.
Yeah.
There's a lot of good $1 million EBITDA businesses, $1.5 million. And if they were $2 million, they may not be now. And the private equity firms aren't going to get comfortable. Yeah.
EBITDA, right?
Earning for interest, tax depreciation, and COVID.
Yeah.
So for people who are able to have money and make investments now, you have sort of a free reign on deals under $2 million. Also in industries that people don't always like working with, cyclical industries, if you're thinking about chemicals or oil and gas, if you're thinking about sort of some technology plays that people don't necessarily like at the moment. There's a lot of opportunity. John,
I was just going to mention, from a macro standpoint, outside of COVID, I mentioned this earlier, but baby boomers looking to retire, there's going to be a lot of these smaller businesses very susceptible to roll-ups. We've been in a seller's market since 2015. All the smart folks around the room think that that's going to come to an end or start slowing down early part of next year. So all of a sudden you've got a buyer's market from a supply demand standpoint, see multiples decelerate a little bit. I think those roll-up opportunities, like you mentioned, could be a really good place.
Yeah, I think I see that happening. A lot of the deals that I advise people on are under $2 million because it's really tough to find people that focus on that part of the market and are any good in that part of the market, because diligence becomes such an important part of actually getting your return. It's not just the same valuation multiple your favorite deal guy did last year on the same asset. Have we got any?
I was having an independent sponsor, and they told me that if your deal is under $700,000 in cash flow, it's very difficult to sell the company. So
It's difficult to sell it?
yeah.
You mean after you buy it to sell it, or?
No, if you're like representing a company that has under $700,000 in cash flow.
So it's a continuation of the same point. So because it's so difficult under $2 million, it's even more, not linearly, more like almost exponentially under $1 million. Because a lot of those businesses don't have formalized management teams, governance structures, strong customer relationships.
So continuation.
Concentration. A lot of them are in messy places, a lot of them have bad books, all the kind of things that people who are looking at, I want a coupon. That's what all the investors want. We all do, right? You want a coupon, that doesn't look like a coupon, which comes back to the independent sponsor piece, which is who's gonna do the work to formalize that business.
And that's the challenge, right? When you look at companies that are doing less than 700,000 or even $1 million of EBITDA, is if they don't have a structured management team in place, if they don't have, a proper kind of finance strategy or, technology in place, that's all then upon acquisition. If you were to acquire it, those are additional expenses that need to be taken on. And so if you then look at a adjusted EBITDA with all those expenses taken on, then you get to much lower number. And then you got to think about, well, I got to be able to manage my debt service fee, and I have to want to be able to put some, potentially some cash back in, all of the investors' pockets and the family office pockets, get that little bit of coupon into it. There's not a lot of left, right? And so that's why, generally, I think the kind of the sweet spot for like small or mid-sized family office is something that does between $1 to $5 million of EBITDA.
Couldn't agree more. And then you got to think about the private equity firm is not the only capital that needs to sign out on that capital stack for the deal to transact. So even if you're okay with the equity risk on that deal, you have to find somebody who's okay with the debt, and that can be tough as well.
Can you talk about the efficiency in the marketplace? I think Michael kind of thinks that what he said, that on large deals, it's a very efficient. Most things go to auction. Actually, we were in San Francisco in January when San Francisco was still open, and we had a panel, and they said almost everything goes to auction. Almost everything has a representative, and even in lower middle market private equity, most deals have a banker or something like a banker or business broker involved, right? Maybe you guys can discuss all that, the efficiency in that, private equity pricing.
I'll be quick. As a result of being sort of in the lower middle market for the past decade, what I've seen is sort of as you go down market from the KKRs and TPGs, and you start coming down the market to the more independent sponsor-like deals, the market also becomes less efficient. So if a $1 billion company sells, it's going to sell in an auction at the highest price. It's going to fetch the highest price. A business at $3 million EBITDA in the middle of Oklahoma, moving portable toilet rental, septic tank service, and a bunch of roll-off containers, has a bunch of other features that might be not necessarily market-based that may affect the price of that asset. One of them being the willingness of the investor to go get to that place, to go to board meetings versus the business that doesn't do well. And so I think as you start going down market, things become more inefficient. Now, when I say inefficient, people may think bad. Inefficient doesn't mean bad. Inefficient means opportunity. Inefficient means if somebody can fix the issue that's there, then all of a sudden the value can be unlocked. That's how I feel about it. That's what I've seen with you guys.
I would say that regarding, sorry, Michael.
I was going to say, I think that you are seeing more sub-$100 million enterprise value deals being banked by proficient bankers. Atlanta, for example, has a large group of really, really good sell-side advisory firms, many of whom, split off from the old Robinson Humphrey, Crofton Bender, BRA, TM Capital. All these firms are very, very sophisticated and have the infrastructure to do the analytics on the industry, et cetera. And you regularly see those firms on a $25 to $100 million deal. I would say the point is, I agree that it gets more inefficient as you go down market, but it is really, really hard in this market because of the coverage. You're not only competing with family office investors and private equity, which they have a calling campaign at all times, but don't forget that a lot of the independent RIAs that are not attached to a wirehouse have the flexibility to be an alternative. So they're also active in the market. So you have three players looking for the same deal. So it's really hard to sole source an investment. And if you do, then you got to capitalize on it because you're probably going to get in for a great price.
Couldn't agree more. I think those are great qualifications.
And I think part of the reason maybe things get a little quote unquote inefficient as you go down is because, one, in that process, then the total amount of fees that are get associated with it are usually generally a little bit less, but then you also have less people involved. And with less people involved, that means each person who is involved has to do more. So for example, I'm in the middle of due diligence with one of the payment companies I'm talking to, and a couple of quick things that we need to get done. It took a few extra days for the seller to get it ready because they don't have a staff of 100 people to go do it, right? And so it's just about understanding that if you are looking at doing these deals, understanding, keeping that in mind when it comes to what is the time frame necessary to complete due diligence, what is the time frame necessary to be able to complete the QOV and whatever else we need to be done in order to go forward in the deal.
Hey, Marty, can you hear me?
Is that Robert?
Yes.
You have a question?
Yes, thank you. Good to see you all, and thanks for the technology. Rosemary, good to see you as well. For the current topic, can you all address a little bit on how your portfolio companies or your targets are going to be reactive to the stoppage or the adjustment on fiscal stimulus and the PPP being at a lower threshold, because that creates both opportunity, but it may be distress, it may be restructuring. Marty, did you get that?
In parts, Robert, can you maybe text a little bit of that question?
Yeah. It's coming through right now. But it's reaction to the fiscal stimulus being phased out.
Or what's the response to the stimulus being phased out? Any thoughts?
Well, I'm not sure this is exactly what he's asking, but I know that a lot of the larger sponsors told the portfolio company CEOs to pull down all lines early on in COVID, just to have the cash available. I think that next year is going to be uglier than this year, absent additional stimulus, because a lot of companies have been artificially propped up during this process, and at some point the government's going to stop infusing capital in the system, and the businesses that are hanging on by a thread are going to be face a real liquidity crunch, and it could cause a real increase in velocity of distressed M&A, and a lot of opportunities for investors, quite frankly, if you're trying to consolidate an industry that's sort of like, I just had someone call me a couple of days ago about putting together a $400 million distressed hotel property fund. And so you're going to see a little more of that, I think, next year. And when the political situation is resolved and we know who the next president is, I think that's going to cause some behaviors too, especially in light of if Biden-Harris ticket wins. Everyone knows that the tax situation is going to eventually be a lot more egregious than it is now, for business anyway. So
I would also add, right now doing a lot of diligence for both independent sponsors and family offices looking at deals. The issue becomes when you see the PPP debt on the balance sheet, you have to sort of understand what did it prop up. Was it drawn down cash for a rainy day, or was it cash that went right out the door for employees that should have been let go that weren't? Is the business sustainable without it? Will it need more of it to make it to Q3, Q4, 2021? To your point, I think a lot of people have to look at not just where the business is now. We got the EBITDA plus C, which is interesting, but even for companies who are sort of steady state through the pandemic, you still have to figure out how much of that was induced by the government infusion of capital if you don't think it's sustainable, which I think most people don't.
we have some specialty finance clients who fund charged off receivables, and they're not that excited about this year. They're excited for 2021. I mean, they're literally getting ready. They think that there's going to be so much paper in the market next year that the prices are going to go way down and they can really make some money.
At the same time, I looked at an HVAC company for a family office in Dallas, and even though they took the money down, it wasn't like their business was balance sheet. So I don't want to be doomsday oriented. I think good deals are still getting done, but I think it really is a deal by deal basis, having to really go in there and dissect what's sustainable, what's going on, what is.
Yeah, I was just gonna say it's the company, it's the industry, and then it's also geography, plays a big role.
Yeah, for example, the paving company I'm looking at, the main one I'm looking at, I got two ready to go. But the primary one I'm looking at, they took PPP money, they used it, but it wasn't necessary because in all honesty, their business actually took off after the pandemic because they work on mostly non-active roads and non-active lots. And well, for March and April, right, no one was going anywhere. So everything's inactive, but development was getting done. New development was getting done. So they were out there paving every day, and you're outdoors, so you don't have to worry about, close quarters and some of those other restraints. And, their revenue this year is actually going to surpass last year.
Yeah, I'm a member of Entrepreneurs Organization. My partner's in YPO, so we get to see a pretty diversified group of business owners out there. And, within EO and the four of my men, 7 other folks, every one of them, their business is thriving. And we're talking about chiropractic to AC repair to accounting to fire safety, and then e-commerce. That this guy's getting ready to go through a massive exit. So really, it comes down, I think, to the operators, those who stepped on the gas too. I mean, some couldn't do anything because of geography or sector, but a lot are really taking advantage. And it's that K-shaped recovery we keep hearing about.
The other thing that was touched on in the last panel is asset heavy versus asset light. So everybody likes asset light generally, right? But some people are still asset heavy. And from a lending perspective, so how much capital or debt capital you can get on a deal, so how much can you juice your equity returns if you so choose? The businesses with assets are actually doing better. So your trucking companies, your gas stations, your anything that has manufacturing, metal vending, all those things have a sort of a new cliche that they might not have had 6 months ago, 12 months ago.
I mean, I think you're going on a point. I think, the challenges in doing any deal is getting the right balance of equity and debt, right? And those that are asset light, sometimes maybe a little bit more challenging to get the debt you want, and you may have to put a little more equity in to be able to get the deal done. But it's an assessment that you got to do on a deal by deal basis. If it makes sense.
And I would say, comparing and contrasting the Great Recession, 2008, 2009 to the COVID pandemic, the biggest difference, other than the government infusing capital into the system, which they did during TARP and all that as well, is that the credit markets have remained open and cheap capital has been available, which it wasn't in 08 and 09, which is why we didn't do many good deals. We did distressed deals, but I closed the first buy-side deal in Philadelphia since COVID started in June, and that started a cascade of, right around July 4th, somebody turned the spigot back on and people got comfortable doing M&A deals again. And our fall is just crazy because of that, because no one did much in mid-March to end of May.
They still want to put the capital out.
Right.
Don't
And
want
so
to deal with the risk of the presidential.
A lot of people are trying to get this. Yeah,
we're back to pre-COVID levels of deal.
Same here.
It's crazy.
So there's a lot of questions about cannabis. Any thoughts? Are there cannabis franchises out there, or CBD dispensary companies? Maybe you guys can talk about what you're seeing in your different role.
There are quite a few in the franchising realm, and all are so early on, they don't have that proven track record. So I'm not comfortable endorsing any one or two of them, but it's definitely a popular space.
I've seen a lot of folks that are interested. It would be my guess and sort of my sense from talking to people. It's a subset of people that are interested in working with something that's not sort of federally okay. And so some people are sort of okay in it, and I think the people who are okay are going to get sort of massive returns for taking on that risk. And I think some people are just going to say, hey, I'd rather stick to my knitting. And I respect and understand both point of views.
And dealing with cannabis, I mean, there's definitely, federal legal considerations you got to take into account. For example, you got to be careful about, cross-border deals and investments, because cross-border mean cross-state deals, and how that's structured, because it's still not federally okay. But within the state, I mean, I think part of it, and when it comes to cannabis, I do agree. I think what Robert was talking about in the previous panel, that if you're going to do it, now is the time to do it, because it's still pretty much the Wild West when it comes to the cannabis industry. I mean, last year was completely Wild West, where if you got in, you could have huge returns very quickly. You still can, but the more money gets into it, then those margins will start to shrink. And the best way to get into it is, honestly, you got to get network into it. You got to know the folks. You got to get involved, because that's the only way you're going to get access to deals. And you also, just as any kind of situation goes, when you get a Wild West scenario, you got to be careful of your snake charmers, right? They're out there just saying, hey, I can do this. I know how to grow cannabis. Give me a bunch of money and I'll prove it to you. So
There's a plan.
There's
a plan. There's a plan. Plan is not a business.
Exactly.
Diligence becomes even more important, because also I think the way that cannabis is grown, the strands, the families, how they're broken off, if you don't really understand that and understand how tight those knit groups are that actually have some of the best strands, you can really miss the boat. And then because of the concentration of that, there becomes sort of trust components of sort of who owns the strand, how protectable is it. A lot of conditions go into cannabis. I think it's probably good for a small portion of allocation, right? If you're interested in taking some risk, but I think more people that I encountered are sort of letting that go.
Yeah. And again,
I'm not sure if it's a direct investment. I think there are some funds that have chosen winners that are doing really well. But I think there's so much competitive product out there. And I mean, it's hard to choose growers or the purity of the crop, who's going to deliver it, the synthetics.
And maybe that becomes sort of cannabis as an asset class, which is kind of the fun thing, or sort of the overall industry.
There's several funds in the space. I mean, actually, there was some guy has done 3 SPACs or 2 SPACs out of Greenwich, Connecticut. There's Canadian SPACs, about $800 million, and he's just been rolling up interstate cannabis companies. And so again, he's an expert. I mean, there are experts in this space. Ex-hedge fund guy, but I can do all this in Canada. He's doing it.
There's a lot of different ways to get involved, right? You can get involved in the growing, you can get involved in the real estate, like, hey, I have the warehouse where it will be grown in, so you're not directly involved with cannabis. You can be involved in the distribution or the retail side of it, and making cannabinoids versus different than other aspects of it. So there's a lot of different ways to get involved in it, but I'd say with any level that you get involved, there's definitely a level of security you want to keep in mind. Where I remember there's one cannabis company I was talking to, and their corporate name is different than what they put out there as a brand, because they don't want anyone to be able to find their office. Because initially when they did, I think they had some holdups happen.
Right.
So you got to be careful, especially when you're dealing with what could be considered a lot of cash in the industry.
I really wanted to address the stress because this retiring boomer generation, and because we have seen so many people just hang it up in the last 6 months who survived 2008 and said, 2020, I'm out of here. I feel good enough that I can sell my business. But unfortunately, I'm not going to be able to address that. We have about 2 minutes. If you guys want to do your closing statements and talk about things that people should be focusing on, how they should be looking at the at the private equity space, especially post pandemic. So you guys want to.
So well, I'll kind of handle the distress piece as well. So I definitely think that boomers are a great market to work with. They've created some great companies that they took it to a certain level, and they either did not want to grow it any further because they didn't want the headache, or they didn't know how to grow it any further. And hence, those are kind of my key folks that I work with and try to connect with as far as being sellers and companies I want to acquire and roll out. Some of them may be distressed, some of them may not be, but I think the key is, seeing what they've developed, if it makes sense, giving them a fair value for what they've done, and providing an opportunity to have them be part of this growth, if you can, where they may not take all the cash out now, but if you give them a little bit of rollover equity and you create this roll up, then there's an opportunity for them to really, get some value when you've created value out of a distressed situation.
Yeah, I would just reiterate franchising. I think we covered a lot of ground, but over the last 3 months, our deal flow, deals being done are up 50%. So really an industry that a lot of people are starting to put on the radar, starting to take notice of, either directly or indirectly. My partners and I are doing a small capital raise right now for a thesis that we feel really strongly about. Happy to connect with anyone later today or this next week and discuss franchising in general.
Yeah, I think, 2 industries that are somewhat recession and pandemic proof are technology and healthcare. and especially healthcare technology. I think there's going to come a time where all of us wake up in the morning and we have, various self-monitoring healthcare devices that feed directly into a database where, your blood pressure, your probably blood sugar, everything, and it's going to be predictive rather than reactive. I'm working with some companies that are working on that now, where you can, get ahead of health problems before they appear. So I think that that's a digital health, anything in that space is a good place to be looking and trying to find some sponsors that you can work with. I think, software as a service is also thriving right now. And the key there is just finding, you don't have to go to New York, San Francisco to find great SaaS businesses. The Midwest and Atlanta and Florida are all these markets, Raleigh, they're all producing very, very good software companies right now. And that's where you can find companies at a little bit more reasonable valuation, because, ultimately the exit is a lot nicer if you get in at the right price.
You buy right, you can save and mitigate a lot of your risk. I would say, from my perspective as a sort of buy-side advisor, provider, you really have to be thoughtful, because you almost have 3 periods to consider. You kind of have a pre-COVID period, you have a during COVID period, and you have to have some idea of what you think is going to happen after COVID. And because you're buying now and forward, understanding the past, and so make sure that you're actually looking under all the rocks and checking everything that you need to.
Yeah, I'll say 75% of your deal probably comes out of